overall change or move to international standards is actually slowing down to some extent. Clearly, the regulators, the Securities and Exchange Commission, are focusing right now on what the most important thing is to the U.S. public, frankly to the world economy, which is trying to restore confidence in our financial markets. So that's their current focus. And with international standards currently being proposed to come in, say, in 5 to 7 years, clearly we want them to be focusing on what is most important to the economy today. It's all about strategic planning. What we're not telling our clients today is to go off and do a full-fledged conversion to international standards at this point in time. What we are telling our clients to do is to think about the change strategically, to focus on what is most important to their individual companies from a customer perspective, from a supplier perspective, from a business transaction perspective, from an overall conversion perspective down the road, and to plan their approach strategically so they utilize their resources in the most effective way. It's going to impact different companies' businesses in different ways. Let me give you a couple of examples. If you have an international business that has foreign subsidiaries, and those foreign subsidiaries are being required to go through a change to international standards, CFOs want those changes to be controlled by the central headquarters so that you don't have foreign subsidiaries changing what they're doing in ways that would not be the same way the CFO wants the overall business to be, say, 5 to 7 years down the road. Another example is to think very strategically about the kinds of customers that you deal with. Because for every transaction, you have the company on one side and you've got your customers on the other. They're going to want to structure their transactions, if they happen to be reporting under international standards, in a way that achieves their financial reporting objectives. If you as a business understand what they're thinking from a negotiation perspective, you can better negotiate the better economics for your business. Let's just presume that international standards do come in some period of time. Maybe it's 5 years out, maybe it's 7 years out, maybe it's 9 years out, but at some point in the future, companies have significant transactions that they enter into today that can impact their business down the road. For example, entering into joint ventures with other businesses, depending upon what the accounting standards are for joint ventures internationally versus domestically, will impact how you want to structure that transaction. Another example is companies lease space, or in many cases they're lessors. Those lease transactions go on for many, many years, sometimes 20 or even longer in terms of numbers of years. How you structure those transactions today may ultimately be reported under international standards. So you're going to want to at least understand what those potential implications are. Business combinations is a third example of transactions that you enter into today that ultimately can impact your business a number of years down the road. Stock compensation would even be a fourth one. How you structure your stock compensation today may impact how you need to report under international standards, say 5 or 7 years down the road. Actually, the answer to that is yes. There's a tremendous amount that U.S. companies can learn from the experiences of companies that have already converted, for example, in Europe or in Asia or Australia. Some of the lessons to be learned, for the most part, are issues such as, again, approaching the overall conversion strategically so that you focus your resources where you get the most value for those resources. Using your advisors in an advisory role, not having your advisors completely do the conversion or the transition for you, because when you're all done, you need company employees that understand IFRS to carry the overall reporting forward from that point in time. A third lesson learned is when you get started. generally speaking, in a lot of situations in Europe and other places around the world, they did not get started early enough so that they could actually have their financial reporting under international standards in place at the beginning of the transition period. You're much better off if you actually go through those conversion steps and you do it early enough so that at the beginning of the transition period you can run dual sets of accounts under both your existing accounting standards and under international standards. Actually, it really depends in terms of the length of time over which that change takes place and actually how the convergence process occurs. Right now, there is a memorandum of understanding between the international standard setters and the U.S. standard setters that calls for at least 11 major areas to converge over, say, the next 3 years or so. What that means for companies is that convergence is going to create a platform of constant change in accounting standards that in many cases may be just as difficult, if not more difficult, to manage as a single change process potentially down the road. Systems are going to need to be revised on an ongoing basis to meet the new accounting standards that continually come out. And something that companies ought to be thinking about is that international standards are having a significant influence in this convergence process on U.S. standards, so you might be able to anticipate what some of those systems needs, what some of the new transaction accounting will be by understanding what international standards call for today.